This is Janus Dispatch, Architecture over Narrative. Dispatch number 8 in the Neutral Rail series. The Machine's Dollar. In June 2026, two announcements arrived from the same short list of names. Mastercard launched Agent Pay for Machines, a rail for autonomous software to move money at machine speed, always on. Days later, a consortium that listed more than 140 firms, Visa, Mastercard, Stripe, Coinbase, and Google among them, launched OpenUSD, a neutral dollar stablecoin owned by none of them alone. One is the pipe the machine economy will pay through. The other is the water. They were built by the same people, and almost no one is reading them together. The excitement is all about capability, agents that can read a goal, shop across merchants, and settle a purchase without a human touching a button. Raoul Pal and others have sketched the endpoint: money fast and programmable enough to run at the speed of software. That future is arriving faster than the commentary about it. What almost no one is asking is the older question underneath. Not whether the machines can pay, but whose money they pay in and what that money can do to them. Here is the claim this dispatch will defend. The money being built for the machine economy is intensely programmable and not remotely neutral. And this whole series has been circling the difference. A dollar you can script is not a dollar no one can stop. The agent economy is being built on the first property and quietly enclosed by the second. And at machine speed, the enclosure scales faster than anything the human economy ever managed. Act 1. The money the machines need. Agentic commerce is the model where an autonomous agent executes a goal rather than a click. Tell it to find trail-running shoes under $150 that arrive Friday, and it evaluates merchants, chooses, and pays with no human at the checkout. Money that behaves that way has to settle in milliseconds, cost a fraction of a cent, work across chains, and carry rules a program can enforce. Human payment rails do none of those four things well. A new layer is being built underneath the agents instead, and it is being built fast. The rails have already shipped. Coinbase's X402, live since May 2025, revived the dormant HTTP 402 status code and used it to settle payments in a dollar stablecoin directly over the web. It processed roughly 165 million agent transactions in its first months. Google's Agent Payments Protocol arrived that September with more than 60 partners and cryptographic mandates, signed receipts that bind a payment to an attested intent. Visa shipped a Trusted Agent Protocol in October, and Stripe built one with OpenAI. The plumbing for machines to pay machines is not a roadmap. It is in production, and the money is already moving through it. Visa's stablecoin settlement pilot reached a $7 billion annualized run rate by April 2026, up half in a single quarter, running across 9 chains. Amazon wired X402 into its Bedrock agent service, where a settlement clears in about 200 milliseconds on Coinbase's base network for a fraction of a cent. I read those numbers as the tell that the machine money layer is not a forecast to argue about. It is a build already carrying weight. Act 2. The two atoms. Two different things get called atomic in this stack, and the agent economy needs both. The first is the old one, a swap where both legs land together or neither does, so nobody is left having paid for something that never arrived. The second is granularity, settlement so small it stops being a payment in any human sense. A quarter of a billionth of a dollar for a single model call. Human commerce never needed either badly enough to rebuild for them. Machines need both to function at all. The second deserves more attention than it gets because its real function is to replace credit with settlement. Every billing relationship is a small loan. You consume now, you are invoiced later, and trust sits in the gap. That is why nobody pays per API call today. They pay monthly against a contract with a credit check somewhere behind it. An agent transacting with a service it discovered 4 seconds ago has no contract, no credit history, and no billing cycle. Nano settlement is the only way it can trade without first being trusted. Legacy rails cannot follow it there, and the barrier is arithmetic rather than speed. A fixed cost per transaction makes sub-cent payments impossible, however fast the system runs. At 30 cents a swipe, a payment of a fraction of a cent is not expensive, it is unthinkable. But the crypto answer has its own recursion. Even on cheap chains, the fee dwarfs a nano payment, so the fix is channels. Post-collateral, net thousands of micro-payments off the ledger, settle the balance. That works. It is also a credit relationship again, secured instead of trusted. The aggregation did not disappear. It got collateralized. Atomicity carries the same twist. Settling both legs together removes the intermediary who used to hold them, which is exactly what makes it valuable. But it requires shared state, because both legs must live in one settlement domain, and whoever hosts that domain is the new middle. Atomicity does not abolish the position at the center. It moves it from an institution you can regulate to a ledger, and the ledgers being built for this are permissioned ones run by the same institutions. Act 3. The same names. Now line up the two guest lists, because they are the same guest list. The firms wiring the agent rails are the firms that just launched OpenUSD. Visa runs the Trusted Agent Protocol, the stablecoin settlement pilot, and sits on the OpenUSD board. Mastercard runs Agent Pay and sits on the same board. Stripe built the Agent Protocol with OpenAI, owns Bridge, and is a founding partner of the consortium. Coinbase runs X402, Google runs the mandates. Every name building the way machines pay is a name building the dollar they will pay in. The full roster has since frayed. Several listed firms, especially in Korea, say they were named without ever agreeing. But the names that carry this argument were never the padding. They are the ones that built both the rail and the dollar. That convergence is the whole point. OpenUSD is not merely a consumer stablecoin competing with Circle. It is the guild's own dollar, and the machine economy is the demand it was built to capture. Today, the agents settle in USDC, a coin issued by a company the guild does not own. OpenUSD, ticker OUSD, is the guild replacing the one issuer it does not control with the one it does, precisely as the largest new source of stablecoin demand in history comes online. The pipe and the water, one owner, one qualification, and it grows the further out you look. The overlap in those guest lists is real, but it is a truce rather than a block, and the members do not want the same thing for long. The card networks need a chargeable layer to survive. The platforms need the payment rent to disappear, because to them, it is a tax on their own commerce. And one of them is already building past the alliance. Stripe owns Bridge, holds a federal trust charter for it, runs its own settlement chain, and wrote the agent protocol with OpenAI. That is not a member of a consortium. That is a company assembling the entire stack so that it will not need one. The guild looks like a block from outside and like a standstill agreement from inside. Act 4. Programmable is not neutral. This is the distinction the excitement skips, and everything turns on it. Programmable means you can attach rules to money, a spend limit, a single-use token, a merchant it must be spent with, an expiry. Neutral means no one can stop the payment once it is made. These are different properties, and the agent stack is maximizing the first while deliberately foreclosing the second. Read the designs, and every one is a permission choice. Google's mandates bind each payment to a signed intent. Visa's protocol writes the agent's identity into the request and checks it against Visa's own directory. Stripe's shared payment tokens are single-use, merchant-bound, and time-boxed. Mastercard settles through agentic tokens tied to a verified consumer. This is money that knows who you are and what you may buy and can be revoked at will. It is the most controllable money ever built, dressed as the most autonomous. A dollar aboard can freeze is a leash, however long the lead. The autonomous agent is autonomous inside the leash and nowhere outside it. That is the exact inverse of the issuerless, unfreezable money this series has spent 7 dispatches describing as the only rail that is neutral in the sense that mattered. The machine economy is being handed money it can script to the millisecond and cannot use against the wishes of the people who govern it. Act 5. The Cantillon pump at machine speed. Recall the seigniorage mechanic, because the machine economy scales it past anything the human one could. A stablecoin's reserve yield flows to whoever holds the reserves, never to the holder of the coin. OUSD shares that yield among its listed members, and the law forbids paying it to you. The float is the prize, and the float is other people's money. Strictly, this is not the classical Cantillon effect, which is about who spends new money first. It is seigniorage capture, the return on money that already exists, and the holder is not paying a debt so much as lending at zero while somebody else collects the coupon. The circuit closes badly, because that coupon is funded out of taxes paid by the same public that holds the coin. The same treasury bill held through a money market fund pays the saver 4 or 5%. Held through a stablecoin, it pays nothing by statute. No new debt was created here. Somebody was inserted into the middle of a circuit that used to close. Now put a billion tireless agents on top, transacting continuously at machine speed in a guild-governed dollar. The balances they hold between transactions become the largest pool of costless deposits ever assembled, and the yield on it accrues to the tap owners. Every micro-payment an agent makes is a micro-deposit that earns for the guild, and nothing for the principal who sent it. The machines are not paid the yield, they generate it. Machine speed is machine speed seigniorage, and the agent economy is the demand side that finally makes the Cantillon pump civilizational. The obvious objection is that machines do not hold money, they move it. Float is balance multiplied by time, and an agent optimizing for capital efficiency parks nothing, so high velocity is the enemy of float, and a machine economy could plausibly produce enormous volume and very little idle balance. The answer is that this float does not come from idleness, it comes from collateral. To settle nano payments at all, an agent has to post capital into a channel and leave it there. And to settle atomically, it has to pre-fund the leg it intends to deliver. That capital is locked rather than lazy, and locked capital earns for whoever holds the reserve exactly as reliably as a forgotten balance does. The machinery that makes micro-settlement possible is the same machinery that manufactures the float. That answer holds only as far as the collateral requirement does, and the requirement is not a constant. How much an agent must park is a function of netting intervals, of secondary liquidity, and of how cheaply capital can be summoned just in time, and every one of those is under active attack by people who dislike paying for idle balances as much as the agents do. The float is a contested quantity rather than a structural flaw. The same optimization pressure that produced nano settlement will be turned on the collateral that makes it possible, and if it succeeds, the pool thins even as the volume grows. There is a second-order consequence larger than the float, and it follows from granularity alone. Flat rates, bundles, and subscriptions exist in part because measuring was expensive. When settlement costs approach zero, per-unit pricing becomes viable for everything. Per inference, per row, per second of compute, per call. That is not a payments upgrade, it is a repricing of the digital economy. And perfect measurement is two things at once: perfect price discrimination and a complete record of consumption. It is tempting to say that whoever operates the meter collects the float and sees everything, but the meter and the reserve are not obviously in the same hands, and that distinction may decide who actually wins. An issuer watches a transfer clear. It does not see which agent bought what, under whose mandate, for which purpose. That semantic layer sits with whoever runs the agent and issues the mandate, which is to say, with the platforms. And the richer metering business sits there rather than at the reserve. If the platforms keep the meaning, while the issuers keep the balances, the fight over float is a fight over the smaller half. The rail was never the prize, and the reserve may not be either. Act 6. Friction is the business. There is a fee at the center of human payments that the machine economy cannot be made to pay, and the reason is not technological. Card interchange, roughly 2% at the merchant, is priced for human risk, fraud, chargebacks, disputes, credit, the whole cost of people being unreliable. An agent acting under a signed mandate, settling atomically against a service it will never dispute, has no chargeback surface at all. Charging it 2% is selling insurance it cannot claim, which makes the threat to the networks a question of visibility rather than volume. Interchange survived 60 years because it was invisible and universal, baked into the shelf price with no comparison available anywhere. A parallel channel that clears for a fraction of a cent turns it into a number you can hold beside another number, and rents rarely die of competition. They die of comparability. Two honest limits sit against that. Pass-through is historically weak, and when Europe capped interchange, the saving largely stayed with merchants rather than appearing at the till. And atomic settlement solves the simultaneous exchange of assets, not the delivery of goods. So for anything physical, the recourse a card buys is still worth paying for. The fee collapses where commerce is digital and machine to machine. It survives longest where a human principle still needs someone to complain to. It would be elegant to say the toll simply moves from the transaction to the balance. It would also be too kind. What actually happens is that it shrinks badly, and a fraction of it is rescued. A few $100 billion of stablecoins earning short rates yields something in the low tens of billions a year against a United States card interchange pool north of $100 billion. That is not a lateral pivot into an equally good business. It is a contraction being managed, and the heaviest losses do not fall where the logos are. Of the roughly 2%, the network keeps a fraction of a point, and the issuing bank takes the bulk. The card brands are the visible casualties. The banks are the real ones, which is worth remembering when you ask who lobbied hardest against a public digital dollar. Seen that way, the float stops looking like a clever pivot and starts looking like a lifeboat. It is small, but it is the only remaining claim on a rent in a system whose costs are trending towards zero, and that is why it is coveted out of all proportion to its size. It also explains a move that would otherwise look like self-harm. A card network building zero-fee agent rails appears to be dismantling its own toll until you notice it does not need to hold the float itself. It needs a seat on the body that issues the coin whose reserves earn it. The fee taker does not lose the rent by giving up the fee. It converts from charging the merchant per transaction to owning a share of the issuer that earns on the balance. Read that way, the guest lists in the third act stop being a coincidence and start being the mechanism, which points at the thing underneath all of it. These institutions earn from cost. Efficiency is not their instrument, it is their adversary, and so their real defensive line is not any particular fee. It is the continued existence of a layer that can be charged for at all. Watch where that line is being held, and the separate stories collapse into one move. Permissioned agent rails keep the machine inside the card perimeter so the fee survives the transition. A bill through both chambers forbids a public digital dollar into the next decade while expressly carving out the private kind, which is to say, it forbids the cheapest possible option and protects the chargeable one. A 25% United States tariff on Brazilian goods lands this July, and among the stated grounds is PIX, the central bank's free public payment rail, whose sin was making the fee layer unnecessary at home, now carrying more transactions than cards. 3 headlines, 1 instinct, none of which makes this a guild against the world. The platforms want the payment rent destroyed, because to Amazon and Google and Stripe, it is a tax on their own commerce, and X402 and the agent protocols are the tell. The front does not run between crypto and finance. It runs between those who earn from friction and those who earn from volume, and the incumbents are trying to reach the float before the fee dies underneath them. And it would be too neat to read the permissioned rail as nothing but a rent-securing machine. It scales because most principals actually want the leash, limits, reversibility, an evidentiary chain that ends at a regulated entity somebody can sue. That demand is real, and it is the reason the incumbents hold a position here at all rather than merely a defense. It is not evenly distributed, though, and I have been writing about agents as one population when they are plainly two. An agent shopping for a household carries trivial balances, would never notice 4% on $50, and wants the dispute process very much indeed. There, the governed dollar wins without a contest. An agent running a corporate treasury carries balances where 4% is a real number and a mandate to go and earn it. But it cannot hold whatever it likes either, because policy and audit decide what is eligible collateral. The yield pressure that threatens the float, therefore, does not resolve where the argument expects. It resolves inside the regulated perimeter, in tokenized money market funds that pay what a stablecoin may not, held as the store, while the stablecoin is kept only as the settlement leg. The float thins either way. It thins by compliant substitution rather than by permissionless defection, which is a quieter death and a likelier one. On the utility axis, all of this is a genuine triumph, and pretending otherwise would be nostalgia rather than analysis. 200 milliseconds, a fraction of a cent, always on, with nothing in the human system within an order of magnitude. On the sovereignty axis, it is an enclosure, the agent that must act without asking, whose principle does not trust Visa's directory, needs money that is neutral and issuerless, and the guild's dollar is engineered to be everything except that. The machines get the fast rail. Sovereignty gets fenced quietly, while everyone admires the speed, and a visible toll is swapped for one nobody can see. Act 7. The 10th man speaks. Until now, this dispatch has made the strongest version of its case. The rule of this desk is to hand that version to its strongest opponent. 4 counters survive. The first is that permissioned money is the feature, not the flaw. Consumer agent commerce needs fraud control, reversibility, and someone to hold liable. A freezable, identity-bound dollar is exactly what makes it safe to hand a bot your card. Most agents are commercial proxies, not sovereign actors. My leash is their seatbelt, and seatbelts are why people drive fast. The second is that the rent I have just described is also the guild's largest vulnerability. A compliant issuer is forbidden by law from paying yield to holders. An offshore or genuinely permissionless one is not. That is a 4 or 5% structural advantage handed to any competitor willing to share the float, and agents are the least loyal customers ever built. No habit, no brand attachment, no switching cost worth the name. If a permissionless dollar token pays its holders and the governed one legally cannot, the machines are precisely the population that notices first and moves fastest. The premise of this dispatch, that agents are pure optimizers, argues against its own conclusion. The third is that I may be pattern matching. The neutral rail frame is about monetary sovereignty, and agent payments may be a user experience and plumbing story that does not carry constitutional weight. Dressing a Rails upgrade as an enclosure of freedom is exactly the move a writer makes when he has a frame and needs a subject. The fourth is that stablecoins may not even win this. Card rails, agent pay, and the trusted agent protocol may end up dominating agent settlement and leave stablecoins a crypto-native slice, in which case the guild dollar as machine money thesis overstates a contest that is nowhere near settled. These 4 counters do not refute the thesis, they locate it. Whether the machine economy is the guild's cantillon pump depends on which rail it actually settles on, and on whether a permissionless lane ever forms beside the governed one. That is contingent, and the contingency is the whole of the bet. Act 8. What to watch, not whether. Watch the settlement, not the demos. The first tell is whether agent stablecoin volume concentrates in guild-governed dollars, OUSD and USDC, and the Visa-settled rails, or fragments onto neutral, issuerless ones. The second is whether the mandate and directory architecture becomes the universal on-ramp, or a permissionless agent money lane forms and takes real volume beside it. Here is the falsification, plain enough to hold me to it, and there are 2 markers rather than 1. The first is the enclosure claim. If agent settlement scatters across neutral rails, above all, onto any permissionless dollar token that pays its holders what the governed one may not, or inward into tokenized money market funds that do the same from inside the perimeter, or if stablecoins lose the machine economy to something the guild does not govern. That reading was a misframe. The second matters more, because it tests the argument this dispatch actually added. If aggregate stablecoin float income stalls, while card interchange holds its ground, then the toll never moved, and I have described a migration that did not happen. Watch the denomination and the rail of agent settlement volume. Then watch the float base against the interchange pool, because that ratio carries most of the claim. There is a third marker, and it is the one I find hardest to measure, because both of the others count money while the deeper argument is about control. It is entirely possible for the float to stay small, for interchange to shrink, and for the guild to keep setting the terms anyway, because it writes the mandate standards, decides who may be an agent, and determines where liability lands. Watch whether agent identity and mandate standards converge on a handful of gatekeepers, and whether an agent can transact at scale without being enrolled with one of them. If both money pools drain and that enrollment requirement holds, the rent moved somewhere my first two markers cannot see. The machines will get their fast money. That part is already shipping in milliseconds for fractions of a cent. But the demand underneath was never for neutral money. It was for measurable money, settled small enough and final enough that a machine can trade without being trusted first. That requirement is indifferent to who issues, which is exactly why it is being answered in a governed dollar and why the meter and the float end up in the same hands. The neutral rail's final frontier is the one where the customer was never human. It is being paved at machine speed by the people who own the meter. Though it would be a poor reading of my own argument to assume the enclosure holds. The Treasury agents are the coldest customers ever assembled. Prices erode rents wherever they become comparable, and the Guild is not exempt from the pressure it is currently applying to the banks. If a permissionless dollar pays its holders what the governed one may not, the machines are the population least likely to stay for the brand. The question is not only whether the machines end up enclosed, it is whether anyone can hold a toll for long in a system this fast at noticing. That was Janus Dispatch. Sources and charts are in the published post. And one disclosure worth saying out loud. The author holds XRP and XRP derivative positions. This is analysis and framework, not financial advice. So do your own research. The next dispatch in the Neutral Rail series stays on the fee that just refused to die and asks what happens when the state itself defends it. A statute forbids the public dollar at home, while a tariff punishes a public rail abroad. Same instinct, two instruments. If this dispatch sharpened your read, subscribe so the next one lands in your inbox. Janus Dispatch is at janusthewatcher.substack.com. The long arguments are in the books. The transition sequence, 2 volumes, 1 thesis, the ground is shifting. Book 1, The Proto-Post-National Age. Book 2, The Frame. Available on Amazon, paperback, and Kindle. The dispatches connect. The books carry the weight. Architecture over narrative.